Okay, welcome back. Well, we're talking global still because a lot of it, of course, what's happened over the last fortnight or so is global. Neeraj Seth is with us. He's the Chief Investment Officer, Head of APAC Fundamental Fixed Income at BlackRock. He's with us here on our studios. Neeraj, pleasure to have you with us here. Thank you very much for your time.
Thank you.
I think the question remains unchanged, even though we've spent some time in more calmer kind of waters over the last few trading sessions now, after that big panic and scare towards the beginning of last week, Monday especially, Monday and Tuesday. Do you think we've put all of that behind, or there is perhaps, as some are saying, usually it never ends with just one, there's something coming, another wave of panic shortly which follows thereafter?
So I think what we saw last week, you can put that behind. It's not over. There's potentially going to be more volatility, but are we going to see that in the immediate future? I don't think so. And two important factors there. One, obviously, the markets have started to move towards pricing in the Fed cuts. Now, it's more about the data. What we see from here in the CPI report today, or the claims report tomorrow, or the most important, in my view, is the NFP. So I think the markets will look at that pricing of the Fed cuts and how to think about it. And the second is the Bank of Japan. Now, big shift was the Deputy Governor Yoshhida's speech, which to some extent has put the future hike expectations on pause for now. Is it over? I don't think so. But at the same time, would they try to hike in rest of the calendar year? The probability is low.
Is a rate cut good, or is a rate cut bad now in the US? Because this Goldilocks, just right amount of disinflation, immaculate disinflation, and the Fed allowing the Fed to cut. I mean, does it happen in the real world? I think
it can happen. It doesn't happen every time. If you look at last 50 years, obviously you have had scenarios where it started to gradually slow down and then it accelerates from there, whether it was in 2000, 2001 or in 90s. And 2008 was slightly different scenario given the Lehman bankruptcy and you had a sharp fall down. Now, where we are today, if you look at the US growth and the data, it's slowing down gradually. You're seeing the consumer slowing down. You're seeing the interest rate sensitive sectors slowing down. But you don't really have a big macro risk sitting on the horizon like some of the previous crisis situations. So I think the rate cut is good with a gradual slowdown. If you see an abrupt slowdown for some reason and you get a bigger rate cut, that bigger rate cut will be a negative in my view for the risk assets, because that will actually reflect a much sharper drop in the economic activity, which is not the base case today.
So just to take that point forward, Neeraj, let's work with the former scenario that you get a gradual slowdown and rate cuts which are fairly paced and not dramatic. In that scenario, what happens to risk assets? Is it positive equities? Is it more positive bonds? What do we expect in this gentle deceleration?
So I think it's to some extent positive equities, but if you look at the equity valuations, they have priced in the soft landing. So if the base case scenario is priced, the upside is somewhat limited, but it don't have a lot of downside risk from here. But it certainly is very positive for fixed income and for the bonds, because there, when you think about the rate cuts, two things will happen. The one, obviously, you get the benefit of rate cuts in the fixed income. The second, which is there's a lot of money which is sitting in the short end of the curve. So money market funds at 8.8 trillion, you have close to 4 trillion of the ownership of the short treasury bills. Some of that money trickle back into duration or risk assets in credit. And credit does well in that slowdown scenario. So I think for credit, it's a positive backdrop.
Okay, and just to complete the point on credit, I mean, up until I think last week, if you were here with us, we would be asking you, what's happening because the BOJ is hiking and the Fed is cutting. At least that's off the table. We all know that, we'll probably get this pause from Japan as the US gets into the gentle cut regime. So a point on the yen carry, I mean, you just said that this whole scenario is very positive in general for the US bond market. What about the yen carry? Is that tantrum over and done?
So, well, you saw a lot of cleanup. Now, I don't think it's 100% cleanup, but I've seen estimates that have now gone to 60 to 70% of the carry unwind that happened. So you've seen some of that cleanup. My base case is if the BOJ stays on pause now, the interest rate differentials come back in play, I think very gradually the markets will build up carry. But given the higher volatility, you will not have the same extent of buildup that we had going into last week's situation. So yes, you will see some buildup. If I have to take a base case, I think the dollar yen drifts higher from here.
All right. Hi, Neeraj, and good to see you in the studio, Neeraj. For an India market perspective, inward, everything is looking good. We have earnings, stable government policy as well moving in our favor. Valuation-wise, well, that's debatable because we're not too cheap. But in terms of external cues, we already spoke about central banks. I wanted to ask you about the next big cue, that's the US presidential election. what's going to be good for Indian markets? I mean, what could derail it? Will Trump be better, or do you think otherwise?
So it's hard to say because a lot of it depends on what the policy outcome is, not the person.
Right.
And it's very difficult to speculate where you're going. But I actually think if I look across the world, India is probably one of the markets which will be less impacted relative to other global markets, regardless of what the election outcome in the US is. Because the domestic story across the secular, structural, cyclical, geopolitical, all of those actually aligning is going to remain positive. So yes, there will be impact, but I think India will be a little less impacted than a lot of other global markets.
You know, just a word on politics and local politics here, because what's happened, I think, in the last 3-4 weeks since the election outcome is that political rhetoric, political posturing, political noise has really increased here in India. Does that worry you from a foreign investor standpoint?
Not really, not at this point, unless something changes in terms of the policy continuity. So what we saw, the most important focus after the election outcome was the budget, fiscal consolidation, infrastructure spend, inclusive growth. I think that balance has given some confidence that the government still means business. They still actually are focused on the growth path for the foreseeable future. Now, if that changes, if you see a significant shift in terms of the path of fiscal consolidation or the composition of fiscal, which is 65-70% going in capex for infrastructure build, I think that will worry investors. But today, looking at that, you're getting reasonably good macroeconomic stability. INR, despite a little bit of moves here and there, is stable. I'm not too worried about it.
You know, before we hit air, Neeraj, you were talking about, you used the word late cycle. When you say late cycle, you mean this global risk-on kind of cycle, right? And so there you're in the late stage? I
would say from more so the developed market. And one thing I would qualify, when you look across the globe, from an economic and monetary policy perspective, we have not seen this level of lack of synchronization in the world. You have central banks trying to cut, you have central banks who want to cut but are waiting for the Fed, you have central banks trying to hike. It's just all over the place, and with a very, very different economic and monetary policy cycles. But specific to the US, Europe, UK, some of the developed markets, that's where you're seeing that late cycle dynamics.
All right, fair enough. Neeraj, we'll leave it there. A short conversation, but love to have you sort of here again every conversation if possible, but at least once a month. Thank you very much once again for joining us from our studios here.